Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Professor Sanjay Bakshi, a very famous name in India in value investing, posted an interesting tweet on his Twitter handle the other day. It was a simple quiz that had some important implications for investing. In fact, it still has some important implications for investing. Here's his question in the form of a table. What do you think is the average operating profit margin of this industry with 15 players in it? Now, you'd be tempted to aggregate both the sales and operating profits of all the companies in the industry to arrive at the average operating margin. This method gives you an operating margin of 2%, which I have highlighted in the last row of the table. However, this is misleading. It gives higher weightage to operating profits earned by the big companies, that is, companies from 12 to 15. These companies are big, no doubt, but why should they have a bigger say in deciding the average profit margin of the group? Isn't this a wrong way of looking at things? If there are 4 players in an industry earning 10% margins each, but a large 5th player comes along with 30% margins, shouldn't the average still remain close to 10% as 4 out of 5 players earn that much? Isn't the one with the 30% margin an outlier and hence should not be taken into consideration? Well, if you too are thinking along these lines, then you are bang on. And which is why the average profiting margin of the group in the table above is 18% and not 2.05%, as 18% is the real margin earned by majority of the players in the industry. The 2.05% number, on the other hand, is just the arithmetical result of putting the numbers in the formula. Now, this point may seem elementary, but it plays a big role in the field of investing. So much so that even Ben Graham, the father of value investing, has warned against making this mistake in his famous book, Security Analysis. Here's what he says about it in the book. A distinction must be drawn, however, between an average, that is the mere arithmetical resultant of an assortment of disconnected figures, and an average that is normal or modal, in the sense that the annual results show a definite tendency to approximate the average. Now, what Graham is trying to tell you is that if numbers in a group are a little disjointed, the average may not give you the true picture of the central tendency of the group. In other words, for drawing dependable conclusions on a set of data, the average or the mean may not always be the right statistical tool. In such cases, the statistical tool known as mode, spelt as MODE, mode, may be more dependable. The value which appears most often in a given data set, that is the observation with the highest frequency, is called a mode of data. In the example we just discussed, the operating margin of 18% is the one with the highest frequency. That's the mode of the entire group, the right measure of the central tendency in this case. In other words, if you intend to enter the industry, you can expect to earn operating margins in the region of 18%. Now, what does this have to do with investing, you might ask? Well, a great deal. Allow me to explain with the help of an example. You see, back in 2014, I came across a stock, HIL Limited. It had crashed 50% from a high of Rs 500 per share in 1 year. The company's profits were down a massive 90% in FY14. This led to investors dumping the stock en masse. From a high of Rs 81 in FY13 per share, its EPS had come down to just Rs 10 per share in FY14. However, Rs 10 was not the true earnings power of the company. The true earnings power needed to be arrived at using the historical earnings trend. Now, in this case, both the mean as well as modal earnings are close to each other, that is Rs 70 per share and Rs 80 per share. If we round off the EPS of all the years to the nearest round number, then we get the mode as Rs 80 per share, as that's what the maximum the company has earned the maximum number of times. Giving this rupees 80 per share a modest P multiple of 10 translates into a fair value of rupees 800 per share for the company. While back in 2014 when I was looking at the stock, it was trading at close to rupees 240 per share. Thus it implied a huge discount to fair value. All I had to do was ensure the company was capable of reverting to its average of rupees 70 per share, which it did the very next year when it earned almost rupees 90 per share. The stock price followed suit and went up significantly. For my subscribers, this translated into a gain of an impressive 170% in just 1 year flat. To me personally, it was a great lesson in how simple averages could fall short in arriving at the true earnings power of the company. Across a lot of cases, mode is a better indicator of the true earnings power of the company. The right way to arrive at earnings power of fundamentally strong stocks is not merely to calculate the average in a simple arithmetical way, but to ensure it shows a definite tendency to approximate the real average. And this real average in the case of HIL was an EPS of close to rupees 80 per share. Okay, now what I'm going to do is I'm going to use this newfound knowledge to evaluate whether Zomato, one of the most popular stocks going around, makes a good investment at the current price. Mind you, the stock had eroded market cap to the tune of a whopping 1 lakh crore when it fell more than 70% from its 52-week highs. However, it has recovered since then and is already up 40% from its 52-week lows. Now, is this recovery a dead cat bounce, or does the company have genuine earnings power and is worth a lot more than what the current price suggests? Well, here's the EPS trend of the company over the last 7 years. You see, there's a famous Warren Buffett saying that he does not believe in jumping over 4-foot bars, as there are no extra points for attempting difficult jumps in investing. He believes in finding 1-foot bars that he can easily jump over. Now, if you look at the earnings history of Zomato, it is clearly a 4-foot bar, as its earning power lies in the future. There is no point in calculating the average or the mode of historical earnings, as it will throw up a negative number since all the earnings are negative. In other words, the company has not yet figured out how to make profits and therefore has no earnings power to speak of. Well, in such companies, you have two options. You either do a thorough research on the company and its business model and try to figure out whether it will make profits in the future, and if yes, what will be the number. The second option is to think of this as the Warren Buffett's 4-foot bar and ignore the stock for the time being. You can consider it again in the future when it has shown consistent profits for a period of at least 3 to 4 years, if not more. For us, we are better off finding stocks like HIL Limited, where current earnings have come in much lower than the historical averages and where they can revert to its long-term average. If you think the challenges facing the stock are one-time in nature and can easily be overcome, you should go ahead and invest in the stock if it's available at a discount to its fair value. Please note that this fair value is nothing but a product of the company's earnings power and a P multiple in the region of 12 to 15x. Forgetting that there are no extra marks for attempting a very high jump, investors usually ignore simple companies like HIL Limited and keep themselves busy with a difficult stock like Zomato. In my view, you are much better off finding a stock like HIL Limited and using tools like the average and the mode. So to answer the original question, since we are not interested in doing a deep analysis of Zomato, we won't be in a position to comment whether investors in Zomato will make good money by investing at the current price. Charlie Munger, Warren Buffett's business partner, says that they have 3 boxes for 3 different kinds of companies. These are in, out, and too hard. Well, Zomato for us will go into the too hard pile. Well, that brings me to the end of today's session. Please do not forget to leave your feedback and click on the like button in case you found the video to be useful. I will see you again next time. Goodbye and take care.